My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, we are going to demonstrate an exercise from the textbook. This is going to be exercise 1613. Exercise 1613, and it's going to be kind of an extended illustration. So exercise 1613 on page 988 of your textbook is Southern Atlantic Distributors. And they began operations in 2013. We have all the information about what's going on with the company. They bought a delivery truck for $40,000, and they plan to use straight line depreciation for financial purposes, for GAAP purposes. But the maker's depreciation rates are listed here. So for example, they get a 50% deduction of cost basis in the first year, 30% in the second year, 20% in the third year. So even though the useful life is 4 years, for tax purposes it'll be fully depreciated after 3 years. For GAAP purposes, we will be depreciating $10,000 per year for 4 years. Now what's provided in the problem is income for 2013, and I'm going to add to that, or add some information to the problem, and so that you can see how this deferred tax liability or deferred tax asset issue flows through in the entire process. So what I'm going to do is I'm going to add some additional information here with respect to income. So we already have 2013 income. We know what that is. That's provided in the problem. And then we're going to assume that we also have income for 2014, 15, and 16. And I just have varying amounts of income here, all of which include, or each year includes, $40,000 of municipal bond income. Okay, so our first job here is to figure out what happened in 2013. So let's talk about this a little bit, and then we'll show you how to do the calculations. So in 2013 we had $300,000 of income for GAAP purposes. That includes $40,000 of municipal bond income. So $300,000 here and $40,000 of revenue from municipal bond income. The very first thing we need to do is eliminate any of these permanent differences. Municipal bond income is one example of a permanent difference. Then we also will have a singular temporary difference for each year, 2013 to start with, where there's a difference between the depreciation deduction for GAAP purposes and the depreciation deduction that is allowed for tax purposes. Alright, so let's start organizing the information here a little bit. So 2013, the first thing we do is we deal with GAAP income of $300,000. We subtract out that municipal bond income. Although that is legitimate income for GAAP purposes, it is specifically excluded from taxation and will never be taxed. So we just deduct it right off the top, and we get that adjusted GAAP income, in this case of $260,000. Now that adjusted GAAP income is going to serve as the basis for determining our income tax expense computation. We'll come back to that momentarily, but that's going to be the basis. Now the other thing that we need to do is we need to recognize if there are any differences, temporary differences, in how we recognize revenues and expenses for Southern Atlantic Distributors. So in this particular case, we can see that there is going to be one difference in terms of how we go about determining GAAP income versus taxable income, or one temporary difference, I should say, in between the two income measurements. That being that we have $10,000 of depreciation for this delivery truck in 2013, but we have a $20,000 deduction for tax purposes. For tax purposes, the deduction is 50% of cost in 2013. So 50% of $40,000 is a $20,000 deduction. So that means that our taxable income will be $10,000 less than our GAAP income. Our GAAP income, this $300,000, includes a $10,000 deduction for tax purposes, but for GAAP purposes, but for tax purposes we are allowed a $20,000 deduction. And so we get an extra. The key here is what's the difference in the depreciation deduction. So the difference in the depreciation deduction is $10,000. $10,000 deduction under GAAP, a $20,000 deduction under tax rules. That's an extra $10,000 deduction. And so we have the information that we need now to determine our taxable income. So this is the tax depreciation in excess of the GAAP depreciation. It's not the GAAP depreciation amount. It's not the tax depreciation amount. It is the difference between the two. And so our tax depreciation allowance exceeds our GAAP depreciation deduction by $10,000. So we subtract $10,000 to arrive at our taxable income. Now, since that depreciation deduction is a negative here, that means that we are creating what is known as a deferred tax liability. Whether an item is considered a deferred tax liability or a deferred tax asset is a function of the year in which it is initiated, or the year in which the difference is created. So 2013, the difference is created, and that difference results in taxable income being less than GAAP income. In other words, we are temporarily shielding some income from income taxes. The other way to say that is that we are deferring into future time periods the tax liability on that income. So we have GAAP income of $260,000. We have taxable income of $250,000. That's realistically all we need to determine the journal entry. And so we take our $260,000 of GAAP income, multiply it by the tax rate of 40% that was given in the problem. That's $104,000 of income tax expense, and income tax expense gets debited. Then we have our taxable income of $250,000, also multiplied by the tax rate of 40%, and that gives us our income tax payable, what we actually owe to the IRS this year. And that's $100,000. We can see that there is a difference between the income tax expense and the income tax payable, and that difference requires a credit entry, or a net credit entry, in order to balance the journal, the transaction. Since we only have one item that is causing the difference between GAAP income and taxable income, we know that this is a deferred tax liability, and it's a credit entry in order to get the transaction to balance. Okay, so that's the transaction that happens in 2013. Now, what shows up on our GAAP financial statements? The balance sheet is going to show two liabilities: income tax payable, that's certainly a liability, and deferred tax liability is also going to show up as a liability. The difference between the two, however, is that the deferred tax liability in this particular case is going to be classified as a non-current liability. And that's because it is being created in 2013, but it's going to take 4 years for that to work itself out, for the depreciation deductions to match in total over the 4-year period. So that's why this is a non-current liability. It's going to be another 3 years. We've completed 1 year, 2013, so it'll be another 3 years before that deferred tax liability goes away completely, and therefore it is a non-current liability. And even though we are emphasizing the balance sheet presentation, we do know that there's going to be an income statement effect, And some of the problems in the textbook will specifically ask for net after-tax income. Well, our net after-tax income on the GAAP income statement, we have $300,000 of pre-tax income, and then we have $104,000 of income tax expense. And so that would leave us with $196,000 of after-tax income. Think about what shows up on the GAAP income statement. The GAAP income statement is going to show GAAP income minus our income tax expense. That will be net income. All right, let's turn around now and take a look and see what happens in 2014. So in 2014, we know that operating income or GAAP income is $350,000. That was not originally part of the data in the problem, but that's something that I've added here. So 2014, we're going to assume that GAAP income is $350,000. The rest of the problem, we're just going to continue on with what happens in 2014 then. All right, so we've already looked 2013, and here's 2014. So we start out with that GAAP income of $350,000. We are going to subtract, again, that municipal bond income. Each year, we are assuming that we have $40,000 of municipal bond income. And so that just gets deducted right off the top to arrive at our adjusted GAAP income. Now, what we need to do is figure out, again, what happens with the depreciation deduction. Specifically, what's the difference between the two depreciation deductions? For GAAP purposes, we will once again have a $10,000 deduction. It's $10,000 of depreciation each year for GAAP purposes. For tax purposes, the depreciation rate is 30% of the cost basis. So 30% of $40,000 is $12,000. So once again, our tax depreciation exceeds our GAAP depreciation, but obviously the difference between the two is a little bit smaller here now. The difference is only $2,000. We have a $10,000 depreciation deduction for GAAP purposes, but a $12,000 deduction for tax purposes. That's an extra $2,000 of depreciation deduction. We're going to handle that the same way as we did in 2013. We take a extra $2,000 depreciation deduction, and that means that we are going to be adding to that pre-existing deferred tax liability account. We created the deferred tax liability account in 2013, and this computation is going to result in an addition to, or an additional credit to, that deferred tax liability account. So the journal entry, once again, we take our adjusted GAAP income, multiply it by 40%, gives us our our income tax expense. Taxable income multiplied by the tax rate tells us what our income tax payable is, and we can see here that once again we need a credit entry to get this transaction to balance. That credit entry is going to go to deferred tax liability again, and then the amount is going to be $800. So what happens on the balance sheet is, again, we would show current liabilities, or among our current liabilities would be income tax payable. That's the $123,200, exactly what we computed here. The non-current liability, called deferred tax liabilities, now has a balance of $4,800. $4,000 balance initiated in 2013, and an $800 addition to that balance in 2014. So I'm going to skip back here to 2013 momentarily. So we see here deferred tax liability. We created the account with a $4,000 credit, and now in 2014 we're simply adding $800 to that balance. The GAAP income statement is going to show net after-tax income of $226,000. $350,000 of GAAP income minus $124,000 of income tax expense leaves us with net after-tax income. Okay, so now let's move on to 2015. In 2015, we are assuming that our starting point, our GAAP income, is $375,000. And once again, we have municipal bond income of $40,000. So I'm going to go ahead and skip to 2015. And there's our $375,000 of GAAP income. We subtract the municipal bond income again of $40,000. There's our adjusted GAAP income. And now we have to deal with the depreciation issue again. So what happens in 2015 here? Well, for GAAP purposes, again, we have a $10,000 depreciation deduction. And in 2015, for tax purposes, 20% is the maker's rate. 20% of $40,000 is an $8,000 depreciation deduction. Notice here now in 2015, this is where things are going to begin to turn around. Now we have a GAAP depreciation deduction of $10,000, but tax depreciation deduction is only $8,000. In the first 2 years, our tax depreciation exceeded our GAAP depreciation. In 2015, it's beginning to turn around. Now our tax depreciation is going to be less than our GAAP depreciation. And so we still have to deal with that initial deferred tax liability, but now instead of building the account up, we're going to begin to draw it down. And so let's take a look at what happens in 2015. So our depreciation adjustment now is in addition to our GAAP income rather than a deduction from our GAAP income. In other words, taxable income is now going to be $2,000 more as a result of that lesser depreciation deduction for tax purposes. We get a $10,000 depreciation deduction for GAAP purposes, but only an $8,000 deduction for tax purposes. That means that we need to add $2,000 back to our taxable income. Everything else, the process though, just keeps repeating itself. Income tax expenses again based on adjusted GAAP income. Income tax payable is based on our taxable income. And notice now we need a debit entry to make this transaction balance. The debit entry, however, does not go to a deferred tax asset. This goes to the deferred tax liability. The existing deferred tax liability now is going to begin to be drawn down. And so the balance sheet, we still have among our current liabilities income tax payable of $134,800. And we still have a deferred tax liability, although that account balance has now begun to drop. Also notice here that this is going to be classified as a current liability. As of the end of 2015, we know that 2016 is the last year for depreciation related to this asset, and so the deferred tax liability account will be completely wiped out at the end of 2016. That makes this a current liability as opposed to a non-current liability. So let's take a look at what happens in 2016. So in 2016, we are assuming we start out with $340,000 of GAAP income. And once again, we have to deal with the depreciation issue as well as the municipal bond income issue. So let's take a look at the depreciation issue. For GAAP purposes, we'll still have $10,000 of depreciation included in that GAAP income computation. $40,000 original cost, subtracting $10,000 a year for 4 years. Notice, however, that there is actually no depreciation deduction for tax purposes. For tax purposes, we've already fully depreciated the asset. 50% in the first year, 30% in the second year, 20% in the third year. That's a total of 100%. As of the end of 2015, for tax purposes, the asset is completely depreciated. So let's see how we handle the computations here. So in 2016, once again, we deal with the municipal bond income, and now we have the depreciation difference. Again, our GAAP depreciation is going to exceed our tax depreciation by a total of $10,000. We have $10,000 on the GAAP income statement and zero deduction for tax purposes. So that means that our taxable income is going to be $10,000 more than our GAAP income. So the journal entry goes the same way. Debit income tax expense based on our GAAP income, credit income tax payable based on our taxable income. The difference now requires a $4,000 debit entry. And that's a result of this positive adjustment to arrive at or to reconcile to taxable income. The $10,000 difference in depreciation deduction multiplied by the tax rate is a $4,000 debit entry. The transaction balances, and now what will show up on our 2016 balance sheet is just simply our income tax payable of $124,000. There is no remaining balance in the deferred tax liability. We created it in 2013, built it up in 2014, drew it down a little bit in 2015, and then ended up completely wiping it out in 2016. And so we have completely eliminated all of that deferred tax liability. The income statement, once again, is going to show net income, in this particular case, of $220,000, GAAP income of $340,000, income tax expense of $120,000, and that leaves us with $220,000 of net income. Now let's take a look at all 4 years combined, and maybe that will help put things in a little bit more of a perspective. So here's a summary of what happened in 2013, 14, 15, and 16. This is nothing more than replicating what we just did on a year-by-year basis. So here's our income tax expense for each year, and here's our income tax payable for each year, and the difference was going into a deferred tax liability account. So in the early years, 2013 and 2014, we needed to be building up that credit balance, created in 2013, build it up in 2014, draw it down a little bit in 2015, and then in 2016 the balance is zero. And so you can see that over the entire 4-year period of time, income tax expense and income tax payable are exactly equal to each other. In any given year, there is a difference between the two. That difference is purely the result of differences in this depreciation deduction, and that's why this is referred to as a temporary difference. Over the 4-year time frame for this asset, income tax expense and income tax payable will be exactly equal to each other. In fact, if we added up taxable income over the 4 years and GAAP income over the 4 years, those would also equal each other in total. In any given year, there are going to be differences, but in total, they will eventually equal. So that's an extended example of exercise 1613. We start in 2013, and then we've added some extra data to show you the entire 4-year cycle for this particular asset.